I am now pleased to introduce our first speaker, Dr. Atul Gupta, Assistant Professor in the Department of Healthcare Management at the University of Pennsylvania Wharton School. Dr. Gupta's recent study on private equity ownership in nursing homes was cited in the 2022 State of the Union and by subsequent regulations to improve transparency in nursing home ownership. We are honored to have him with us today to share his perspective and expertise. Atul?
Good afternoon, everyone. Thanks to NIHCM for inviting me on this prestigious panel. I'm really excited to be here and to get us started. My talk is really going to be focused on three parts. The first part, I'm going to try and explain in simple words, in as simple words as possible, what private equity is, and sort of set the stage and get everybody on the same page. It's admittedly a complicated concept that took me some time to understand. The second part, I'm just going to give you some facts on the trends in private equity involvement in US healthcare and make the case that private equity has dramatically increased over the last few years. And in the third part, I'll again give my own views and based on the literature and my own reading on why it is the case that private equity has grown its involvement in healthcare and what the implications could be. Next slide, please. So what is private equity? So in the most simplest terms, let's break down this term private equity. So the first word, private. Well, private just denotes the fact that when these transactions happen and a private equity firm acquires a stake in a company, that firm is quote unquote taken private. So if that firm happens to be publicly listed on a stock exchange, they actually delist that firm and it's under private control. There is no public reporting on the financial performance of the target firm. There's also no transparency for entities that are outside of the deal, and that includes regulators, researchers, customers, any stakeholders who are sort of interested in how the target firm is doing until there's some legal action. And this transparency, unfortunately, or the lack of transparency, unfortunately, also sometimes extends to ownership. Oftentimes, it's not exactly clear who owns how much of a stake in the target firm. And I'll expound more on that when I talk a little bit on the next slide about how they generate profits from these deals. The second word is equity. Well, equity really relates to the source of the capital that's used to acquire the stake in the target firm. And for this, I'll have to explain a little bit on how this all plays out. So private equity firms are typically organized as partnerships. These partners, who are sometimes also called general partners, they approach investors to ask them for money or funds, which they're going to apply to a specific fund. The fund that they try to raise money for usually has a targeted purpose. So, it could be a sector specific purpose, like let's say healthcare, or even more narrow than that, like healthcare tech. They may also have a size focus. So there could be different ways in which these funds could be targeted, but that's usually how they organize them. And then they appropriately approach investors who are interested in those sectors. Who are these investors? Well, these investors are sort of a variety of groups, typically large institutions like pension fund managers, endowments, sovereign wealth funds, and sometimes even wealthy individuals. For example, some of the largest investors in private equity funds actually are the California Public Employees Pension Fund Managers, CalPERS, and also the Pennsylvania Public School Teachers Pension Fund Manager. So the PE firm gets money from these investors. That's the source of their capital or equity. They then combine it with lots of debt that they raise from lenders, banks typically, and they use this corpus of money to acquire a controlling stake or controlling stakes in the firms that they're interested in investing in. So this is a key aspect of private equity. They acquire controlling stakes. They don't just take a small stake in a target. They actually want to control that firm. And this is a distinctive characteristic of private equity. They usually have a very limited time horizon as far as this controlling stake is concerned. They look to sell this stake either to another private equity firm or by listing the firm on the stock exchange. They have various ways of what they call exiting the stake, and usually this happens within 5 to 8 years from the time that they invest. How do they make money? Well, they have three revenue streams. One is they get a small share of their revenue from what is called annual management fees, which they take from the funds that they raised from these outside investors. That's usually about 1 to 2% of the total corpus of capital that was committed by the investors. And you can think of it as, that's the money that they take for the job of identifying targets, investing in them, managing those investments, etc. The biggest part of their revenue comes from their share of profits that they receive when they sell their stake. So from the so-called exit, usually they get about 20% of the profits. For some reason, this is known as carried interest. I'm not entirely sure why. I'm sure there's some legacy reasons. And you probably heard a lot of debate about carried interest and the carried interest loophole. And I believe Erin's going to talk a lot more about that. Um, and then the third source of their revenue is so-called monitoring fees, which they take from the target firm. So the target firm, for the privilege of being managed by a private equity entity, they have to pay the private equity owner monitoring fees. This is also usually a small amount. The vast majority of their revenue comes from their share of the profits when they exit. Next slide, please. Okay, so how do they make money? The literature has sort of thought about this in three ways. The most important way is financial engineering. Um, the single most critical aspect of private equity financing or private equity control of these targets is the fact that they use a lot of debt. 60 to 90% of the deal value is financed using debt. And that's one reason why these acquisitions were historically known as leveraged buyouts, where leverage denotes the debt. In fact, I sometimes joke that private equity should actually be called private debt because debt is by far the more important component. This debt, interestingly, is not placed on the balance sheet of the private equity fund. It's placed on the balance sheet of the target firm. So imagine that the private equity firm acquires a stake in a hospital or a nursing home. They actually put all that debt which they use to buy the nursing home on the balance sheet of the nursing home itself, which is quite interesting. Um, the use of debt is very important in terms of profitability for the deal because it reduces tax liability, obviously, because interest payments are sheltered from tax. And then it also increases return on equity because it reduces the amount of capital that's required to actually finance a transaction. So you can actually go out and buy more firms with the same amount of money because you're using all this debt to finance the transaction. So this was the initial innovation or ingenuity in private equity when it first started in the 80s. Over the last couple of decades, they've added a couple of more financial engineering tools. So one is that they also target firms which have real estate, and then when they acquire these firms, they actually unlock the value of the real estate, so to speak, by actually hiving off the real estate ownership from the operational part of the company and then selling that real estate. And they try to do this fairly quickly. Within a couple of years of their ownership of the firm, they'll separate the real estate and sell it off. The sale of this real estate, which is called sale leaseback sometimes, it unlocks the capital even before they formally sell their stake in that target. And another recent thing that's sort of another example of financial engineering is the so-called dividend recapitalization. I know it's a complex word. All it means is after they acquire the firm, they go out and try to get more debt, which they can put on the balance sheet of the target firm to unlock some of the capital that they invested. And how do they do that? Is once they get that debt, instead of using that debt to improve the operations of the firm, they use that debt actually to get paid themselves in the form of dividends. So this is the financial engineering, which in my view is the core of the private equity playbook. But then in addition to this, they do some other things as well. There's this so-called governance engineering. And what that means really is that they change the leadership of the target firm. They bring in people who they have more faith in, who they think are more expert in running firms the way they want them to be run. They rejig the governance board. Oftentimes the partners of the private equity firm are now placed as directors on the board of the target. And most importantly, they change the performance incentives of the leadership team of the target so that they're more responsive to aspects that the private equity firm cares about. And finally, there's operations engineering, which is a more recent addition to the toolkit. At the end of the day, they will get a higher value from their sale of the stake if they increase the firm's profits. So how do you increase profits? Well, you reduce cost and you increase revenue. Jane and Zirui will talk a lot more about this in the healthcare context. I'll just give some high-level points. On the cost side, they're known to cut staff. In healthcare context, staff is a very big component. They also realize scale efficiencies, typically on the procurement side. On the revenue side, they do all the usual things that you could imagine. They renegotiate the prices with insurers so they can get higher prices. They try to increase patient volume using some referral techniques. They increase treatment intensity by doing more complex procedures. And sometimes, they can also indulge in things like upcoding. But this is really just a high-level view. Jane and Zirui will talk a lot more about this. Next slide, please. So I've given you an overview, and you might still be wondering, well, this sounds not that different than conventional for-profit ownership. Don't we always think for-profits are somewhat evil, and maybe they shouldn't be in healthcare? So it is true that for-profits are profit motivated, and that's been a very, very old debate in economics, and particularly in health economics. But even relative to conventional for-profit organization, private equity is a little bit different. And I think it really comes down to 3 points. The first point is this financial engineering aspect of how debt is used. Debt is a big part of the deal acquisition, and it's placed on the balance sheet of the target. So now the target has to pay interest and repay this debt, right? There's little capital infusion into the target in order to improve its own operations. If you compare that or contrast that to what usually happens in a regular acquisition, obviously debt does play a role, but that debt is not necessarily placed only on the balance sheet of the target. It's usually on the combined entity's balance sheet, and therefore it's the joint responsibility of the combined entity to repay that loan. So debt plays a very important role in distinguishing private equity from how these types of deals are financed in other types of for-profits. The second aspect is the short-termness. So private equity firms, they make most of their money when they sell their stake. And so exiting is very, very critical to making a profit from the deal. And they usually have to do it in 5 to 7 years. And that makes them prioritize certain things to increase value from the deal. Like I mentioned, the sale of real estate, that's one way to do it quickly. Another way to do it quickly is to cut staff. There are some things you can do quickly, and there are other things that require time. And the way private equity is organized, they tend to focus on the things that can happen quickly. In contrast, as a going concern, a for-profit doesn't necessarily need to exit to make a big payoff from their investment in a firm. And so that changes their priorities. And the third part is this moral hazard. Private equity firms can do well even if the target firm suffers. We've now seen multiple examples, even in healthcare itself, and many more outside of healthcare, where the target firm often goes into bankruptcy, but the private equity fund itself, actually did quite well on the deal. And this happens for a variety of reasons. Debt, as I've already said, because the debt was placed on the target's balance sheet, not on the private equity firm's balance sheet. So it's the target's responsibility to pay that back. Secondly, if there are any losses, the losses for the private equity firm are limited to its own equity investments, which tend to be quite minimal. And then the third one is in terms of reputation loss. Somehow there's a minimal hit to reputation loss. We've now had pretty celebrated examples of bankruptcy for some of the largest private equity firms. It doesn't really seem to affect their reputation because for some reason it's seen as it's par for the course in this industry or in this business that some of these deals will go sour. On the other hand, when you think about a regular for-profit, let's say, a regular investor, the fortunes of the investor are quite intertwined with the fortunes of the target. And this is particularly even more so if the target happens to be listed on the stock exchange because there's a lot of public reporting that's involved, there's a lot of liability that's involved because of regulators. And so there, I think this moral hazard aspect is mitigated. Next slide, please. Okay, so now that we have some understanding of what private equity is, I'll just give a couple of facts. So one fact is that private equity investment in healthcare has grown very dramatically in the last decade. It was relatively flat in 2000 through 2010. There was an uptick in 5 and 6, 7, but then again with the Great Recession, things dampened down. But it's been almost monotonically increasing over the last decade, peaking in 2021, and now in 2022, with the overall economic outlook becoming a little bit less rosy, the number of deals and also the value committed has dropped. So it peaked in 2021 at about $100 billion of investment across the healthcare sector with about 1,400 deals. Next slide, please. And the investments of private equity firms in healthcare has increased disproportionately to the increase overall in the economy. So this figure is showing, pretty much the same sort of numbers, but overall, investment across all sectors in the US. This is for a shorter time horizon, but you can see that it's much more muted. And as a consequence of this, the share of healthcare of private equity, both deal value as well as number of deals, has increased from 2012 about 5% to about 10 to 12% in 2021. In 2022, it dropped again a little bit, but still higher than the 5% that it was in 2012. Next slide, please. So why is private equity investment grown so rapidly? Well, there's both supply and demand side factors, right? So on the supply side, there's cheap debt. Whenever there's cheap debt, it really fuels private equity acquisitions because they're so debt reliant. Policies have become more favorable over the last couple of decades, where corporate practice of medicine laws have been relaxed. Antitrust scrutiny is somewhat limited, and Erin will talk more about this. For lack of a better word, there are macro factors. Healthcare is seen as being recession-proof. We're an aging society, so healthcare seems to have, good growth potential. The government is heavily involved. There's great political will behind this. And then there's, of course, some micro factors like consumers are relatively inelastic in terms of they're not very sensitive to both quality as well as prices because insurance is a very integral part of this. On the demand side, at the end of the day, providers and other segments within healthcare, they want capital. They need capital to grow and to defend themselves in a competitive environment. And private equity offers another source of capital. And private equity firms are also very nimble. Next slide, please. And I'll actually skip this one in the interest of time. And I'll move to my last slide just to close things out, which is all of this is well and good, but why should we care about private equity investment in healthcare? In fact, the evidence from other sectors is actually quite positive. They lead to growth, they lead to improvement in efficiency. But we have to remember that healthcare markets have some uniquely dysfunctional features. Quality is very difficult to observe. And as a consequence, consumers don't punish poor quality providers. The market doesn't punish poor quality providers as much as it should. Consumers are relatively insensitive. They don't observe quality as much, and they don't pay on the margin, so they're relatively insensitive to price. The government plays a huge role, and government prices are fixed. They're not necessarily responsive to quality. And then the markets for some services are concentrated, and in general, there are big entry barriers. So I'll leave it there. I think I ran 1 over time, but hopefully this is a good segue for Zirui and Jay.
Great. Thank you so much, Dr. Gupta, for setting the stage. for this conversation and outlining the recent growth trends in private equity.